and overvaluation. In a different way, this phenomenon was repeated in 1961 and 1968, the emphasis now being placed on new offerings of the shares of small companies of less than secondary character, and on nearly all companies in certain favored fields such as electronics, computers, franchise concerns, and others. As was to be expected, the ensuing market declines fell most heavily on these overvaluations. In some cases, the pendulum swing may have gone as far as definite undervaluation. If most secondary issues tend normally to be undervalued, what reason has the investor to believe that he can profit from such a situation? For if it persists indefinitely, will he not always be in the same market position as when he bought the issue? The answer here is somewhat complicated. Substantial profits from the purchase of secondary companies at bargain prices arise in a variety of ways. First, the dividend return is relatively high. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In a 5 to 7 year period, these advantages can bulk quite large in a well-selected list. Third, a bull market is ordinarily most generous to low-priced issues. Thus, it tends to raise the typical bargain issue to at least a reasonable level. Fourth, even during relatively featureless market periods, a continuous process of price adjustment goes on, under which secondary issues that were undervalued may rise at least to the normal level for their type of security. Fifth, the specific factors that in many